Telecom stocks have pulled back in recent months. Verizon's down around 6% since early September, while AT&T has fallen 12% and Comcast has slumped roughly 20%. At the same time, their dividend yields now range from 4% to almost 7%, which is why income investors may want to take another look. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. In today's video, we'll go deep on Verizon, Comcast, and AT&T, covering dividend safety, valuation, competitive positioning, everything to help us try to figure out which of these high-yield stocks could be the most attractive going forward. And if you stay tuned through the end, I'll share my final rankings and which of these companies I personally hold in my own portfolio. Let's get started with Verizon. I'll be using our website Simply Safe Dividends to analyze these stocks. Our site makes it easy to track your dividend portfolio and stay on top of dividend risk. If you want to use the same tools, there's a free trial in the description below. No credit card required. The appeal with Verizon is pretty simple. You're getting a yield near 7%, which is much higher than AT&T's and Comcast, but still backed by a safe dividend safety score from us of 70, which indicates low risk of a cut. Verizon also earns a BBB plus credit rating from S&P, which signals a reasonably strong balance sheet. Verizon's not the fastest grower. The most recent dividend increase was just 1.8% back in September, but this is meant to be a defensive, dependable income stock rather than a compounder story. You can see that slow and steady profile right here, nearly 20 straight years of dividend increases, but almost always in that 1% to 2% range over time. It's a predictable stock, just not a very fast one. Valuation also looks reasonable today. Verizon trades close to its 5-year average P ratio, and the yield is near its long-term norm. With income stocks, starting valuation matters because most of your return comes from the dividend. But valuation only helps if the business itself is stable, so let's look at some of the competitive trends. This is the heart of Verizon's challenge. Over the last several years, T-Mobile and AT&T have added far more postpaid phone customers, while Verizon's base has barely grown. A lot of that slowdown traces back to churn or losing customers to competitors. You can see the spike in 2022 when Verizon had been leaning much harder on price increases than its peers, who largely kept prices flat. With inflation pressuring consumers to seek more value, more customers left, and churn hasn't fully normalized. This is exactly what the new CEO Dan Schulman from PayPal is trying to address. His plan is to simplify customer plans, improve customer service, bundle home internet more effectively, cut costs, use AI to remove friction. It's not a dramatic shift in strategy, but it's the operational cleanup Verizon has arguably needed. The encouraging part for income investors is that despite these competitive issues in recent years, the dividend is still well covered. Verizon's free cash flow payout ratio sits just below 60%, which is a reasonable level for most telecom companies that aren't overly stretching themselves financially. Balance sheet-wise, leverage has been elevated but manageable. Verizon remains investment grade, and we expect leverage to gradually move back towards the firm's target range by 2027 as free cash flow slowly grows and debt is reduced. That's a big reason why the new CEO felt comfortable reiterating an ironclad commitment to the dividend on the earnings call in late October. So overall, Verizon remains a high-yield, slow-growth holding that's working to stabilize its competitive position under new leadership. If churn improves and the subscriber base firms up, investor sentiment could shift quickly, especially if interest rates ease. But even if progress is gradual, I think Verizon still offers a well-supported yield near 7%, essential services, and a balance sheet that keeps the dividend on solid footing for now. Up next is Comcast, and at first glance, this looks like one of the safer income names in the telecom sector. You're seeing about a 5% yield, a safe dividend safety score, and an A- credit rating, all backed by a business that still produces a lot of free cash flow. That part of the story is the easy part, though. The harder part is what's happening underneath the surface, because Comcast's future really depends on one thing: the stability of its broadband business, which earns the bulk of its profits. Dividend growth has been solid for over 15 straight years, and historically it's been surprisingly strong as well, but those past trends matter a lot less if the core broadband business keeps weakening. And this is why we're a little cautious about Comcast. The competitive landscape for home internet is shifting quickly. AT&T is doubling its fiber footprint, Verizon is pushing fixed wireless to 90 million homes, and T-Mobile's broadband business, with the help of some M&A, has gone from 0 to over 40 million homes covered in less than 5 years. Every bit of this expansion overlaps almost entirely with Comcast's footprint. Comcast already passes around 64 million homes, which is roughly half of America's total households, so competitors are essentially building right on top of its map. And Comcast is starting to feel it. The broadband base is drifting lower, not by a lot, but steadily, while AT&T, Verizon, and T-Mobile keep adding customers. In a business where growth used to be a given, that's a pretty meaningful shift compared to just a couple of years ago. Now here's the clearest view. Trailing 12-month net subscriber adds have slipped into negative territory and continued sliding at around a 1% to 2% annualized pace. It's far from catastrophic, but it's a real reversal from years of steady growth, and with more competition coming as network coverages expand, it's hard to argue this will turn around by itself. Another structural challenge is convergence. So wireless carriers own both mobile and broadband networks. They can bundle those services cheaply and aggressively. Comcast can't do that to the same degree because its mobile service runs on Verizon's network, which it has to rent. That limits how competitive Comcast can be on both pricing and bundling. Now, the good news is that the stock already reflects a lot of these growth headwinds. Comcast trades at a very low forward PE ratio, and the dividend yield is well above the stock's norm. For contrarian income investors who believe that cable internet could prove much stickier than the market expects, especially as Comcast works to improve its customer experience, this is what an unloved but stable setup could look like. Importantly, the dividend does remain well covered. Comcast payout ratio sits around 30%, leaving room even if cash flow weakens a little bit to keep that payout covered as Comcast takes action to defend its market share. That's a key reason the dividend remains in our safe bucket. So where does that leave Comcast? It's a financially strong company facing real long-term competitive pressure. The dividend looks safe for now, valuation is cheap, but the broadband picture really needs to stabilize for this to be more than just a contrarian yield play. If losses slow or level off, Comcast could look interesting again. If not, or if the company takes on a large strategic move like buying a media business, the risk profile changes and we would probably be inclined to exit the stock if we were shareholders. Last but not least is AT&T, which has evolved significantly from the old AT&T that many investors might remember back when it depended more on DirecTV and various media assets. Today, AT&T is essentially two businesses, wireless service and home internet. Both are subscription-based, have low churn, throw off steady cash, which all creates a much simpler foundation for the dividend. AT&T's yield is around 4%, which is lower than Verizon's, but it's backed by an equally safe dividend safety score of 70. And since the company reset its dividend a few years ago, AT&T has kept its payout ratio around 40 to 50%, which is a level we're pretty comfortable with. Even with the company investing heavily to build out its fiber network, free cash flow has consistently covered the dividend and is even expected to increase at a decent clip from here. So it's not like AT&T is stretching for the payout, and they're not relying on debt to support both the dividend and their fiber build-out either. The trade-off, though, is dividend growth. AT&T hasn't raised its payout since 2022, and I wouldn't expect increases until leverage moves back down, which we'll talk more about later. But the current payout looks stable is the bottom line. One area that has helped the business become more attractive is the convergence trend we talked about with Comcast. That's where a household uses the same company for both mobile and home internet and usually churns far less while spending more. AT&T is actually the largest fiber provider in America, with fiber already reaching over 30 million locations. That type of scale gives AT&T more opportunities to bundle wireless and home internet together, and it's a big reason why the business has become steadier than it used to be. On valuation, AT&T doesn't look as cheap as Verizon or Comcast. The P ratio has about doubled over the past 2 years, and it's well above the stock's historical norm. The yield also sits well below where it was even after the dividend was reset. So some of the company's stronger execution and improved positioning is definitely priced in. The main thing I'm watching now is leverage. The company's recent spectrum purchases will push debt back up, and management expects to take a few years to work it back down. The BBB credit rating still looks solid, though, and the dividend doesn't appear at risk, but the balance sheet is something that investors should keep an eye on. So overall, AT&T offers a cleaner, more predictable setup than it has in the past, a simple subscription model, a healthier payout ratio, a yield just over 4%, and decent momentum with adding both broadband and wireless subscribers. However, it's the lowest yielding stock of the three names we've talked about, but probably the steadiest operationally. For investors who want income without a lot of surprises, AT&T is a much better place today. So with that, we've now walked through all three of these high-yield telecom stocks, and to quickly pull everything together, here's how they stack up across the areas most dividend investors care about: current income, dividend safety, dividend growth, long-term visibility, and valuation. When I look at these companies through that lens, Verizon really stands out for pure income, right? It's offering the highest yield, a safe payout, a plan to stabilize the business under new leadership, all without hopefully rocking the boat too much. Comcast, on the other hand, doesn't yield as much as Verizon, but it has the cheapest headline valuation and the most near-term flexibility to grow its dividend faster than Verizon and AT&T because it has a much lower payout ratio. In fact, Comcast is buying back a lot of its stock right now. However, the durability of cable broadband is a real concern that could make this business a bit of a shrinking ice cube in the years ahead. AT&T has had the best execution, which is something I never thought I would say a few years ago. The yield isn't as high as Verizon's and the balance sheet isn't quite as strong, but its growing traction and fiber and mobile bundling looks like a true advantage. If I had to rank them purely for high-yield dividend investors, I'd put Verizon first, AT&T second, and Comcast third. For what it's worth, I've personally held Verizon since 2015 and AT&T since 2017. I view both as defensive income positions, not fast growers, but reliable pairs that help anchor a diversified portfolio. As always, that doesn't mean they're right for everyone, but hopefully this breakdown gives you a clearer sense of where each company stands today. If you want to check out dividend safety scores for your holdings and track everything you own in your portfolio to keep it safer and on track with your goals, you're very welcome to start a free trial using our website, Simply Safe Dividends. No credit card required. I'll leave a link in the description below. Thanks for watching, and I hope to catch you next time.